Mhm. So if you understand those concepts, I mean,
I,
it should be fine. I haven't had anybody that's had trouble with this.
it covers first 3 weeks of
Yeah.
the
The homework doesn't, I don't think the homework's that accurate as a representation. It's okay. If I had one thing to print out, I'd print out the first 3 weeks, the summary weeks, which tomorrow I'll have week 3 out there. That's if I had one thing to print out and look at, that's what I would look at. Mhm. Okay.
Are we gonna go over that problem?
Which one, this one?
Yeah.
We just did.
Oh,
I'm just kidding. Here we go.
okay.
So, if you're looking for the natural log, it's an ln function. In Excel, you can use it, okay? If, and thanks to them all, for the n, when you do n d sub 1, n d sub 2, use the normal distribution function, use the d1 number or d2 number that you got, and then I'm all found out that if you use 0, 1, and true for the other ones, it works fine. I'll ship this guys to you after. But there'll be there's no calculation because the concept is more important.
I think the book suggested some other formula for the N. I used. Yeah, it says N, D, and that's what I use from Excel.
Okay. If it works out.
I don't know, I have to see my grade, my points.
Yeah. If it doesn't, I mean,
That's what they say here.
okay.
I use them.
The way I'm familiar with it is the way they set it up in the homework.
That's what it's given in the book, because I missed the class last week, so I had no idea.
Oh my goodness.
What I was doing.
I was horrible last week at the messed up the teacher was.
No.
Professor, would you
I
go
still
to
can watch it, but I haven't had time.
And
That
then,
means different.
oh, so we got 23, right?
Oh, since we're talking about different
See, so that's, you need that,
So you
but
go
in order
first.
to get D1, you need that LN.
I found LN, yeah.
Okay, so that LN gets you D1. and then-
Also, too, I'm not sure, some of you guys actually found the solvers. That helps you out a great deal. In the doc sharing, and I spoke about to you before, but if you go to your homework section and you look at, for example, what were we working on? 20, right? Yeah, that was one of the chapters. So it'll have certain numbers for you. So you got to fill in a couple numbers, and it'll calculate it for you. Okay? These are already pre-made in Excel. Not covering every problem for homework, but covering some of them. So definitely use some of those to your advantage. Also, I didn't mark anything wrong, but a option can't be worth a negative value. It's either 0 or it's worth something. Okay? But make sure you use those solvers if you got them. So anytime you get homework, take a look in that homework section, homework file section, and see they got those out there. They are helpful.
Is that means if the stock price rose by $5
Mm-hmm.
and the exercise value of option will be also increased by 5?
So if I own a call, right,
Mm-hmm.
strike price of $40. Stock's trading at 55. So here's what I do. What's the strike price? 40, right?
Yes.
I gotta do that first, sorry. 40. 55. Stock price, right?
Yes.
Right? That's what they call exercise value. I call it intrinsic value. In the book, it's also called intrinsic value, right? Now, if it's trading at what? 35, right? Well, it's 40. Okay, go down here, 35, right? Worth nothing. Can't be a negative value, right? And see, it draws the graph for you. So, make sure you're not missing like week 1 or something, but make sure you take a look at those. It'll save you some time. Okay. Any questions? And then, now, like I said, not all the problems have them, but some of them do. So when you do have them, if you want, some of you guys submitted 2 different files, one file like this, another file with the other problems, perfectly fine. You don't have to copy this and put it in another document. Just submit what you did here.
To go through the practice quiz, the 6 questions.
I can do that. Ask Matthew as well. Matt, you want to review that for us? Or did you guess? Because it worked.
Yeah,
Doesn't matter.
then I definitely didn't guess.
I don't know, it was number 6, last one. I don't know.
Okay. All the questions, let's see if they're all the same. Should be for the practice one. Yeah, they're all the same. Okay. Which number did you come with? Number 6, you said?
Number 6.
Okay.
It's the bond, annual bond yield,
Okay.
after the,
Okay. So, the hypothetical bond we're always going to assume sell in $1,000 increments, okay? So, 89 plus 8/32. So we have to turn that 8/32 into a decimal. 8 divided by 32. So it's 89.8 divided by 32. Because they never decimalize bonds because they want to be old school. So if I were to do this, I would say, okay, 89, right? Then 8 divided by 32, right? Because they trade in 30 seconds. Times that. Oops. Sorry, close. Add those 2 together. 89.25. So that's where the 89,250 comes into, because that's your price.
that's the price, that's the present value?
Ooh, really? Now here's something else we can do. Now we got the present value, right? Right?
Yeah, 89.25.
Now we need to know the rate. Okay. So what we can do for that is we can plug it into Excel. We have a formula, we have a financial. We have a rate function we can use. Okay. So what they said was 40 years, right? What was the coupon payment? Was $30. $30. We said always present value is negative in Excel. So negative 892 is about 50. That's what we found the price to be. Future value is always going to mature at 1,000. Put that in there. A couple decimal places there. 3.50. Okay. Now, we figured out the semi-annual. How do I know that? Because it says we have a 20-year bond with semi-annual payments. So I take the 20 and multiply it by 2 to get the 40. The 40 is my end periods, right? It's going to make how many payments? 40 payments, right? The coupon is what? $60. 1,000 times 6% is $60, right? Divide the $60 by 2 because they're making semi-annual payments. That's why the payment is $30. So no, when you input semi-annual data into the equation, it's going to spit out semi-annual data, or semi-annual rate. Got to multiply that rate by 2 to get the annual rate. If you put in annual data, it gives you an annual rate. If you put in semi-annual, give you a semi-annual rate, then you have to multiply by 2 to get the annual.
We just calculated in Excel, it's a semi-annual rate, right?
Right, if it says semi, it's on a 20-year bond, then we know we got to take the 20 years and multiply it by 2. Then we got to take a coupon and divide it by half. The present value won't change, the future value won't change. The two components that will change are the time period, right? And the payment.
Would you go back to the Excel, please?
Sure, absolutely.
That's, the rate is 3.5.
Now that's semi, right?
Yes.
So in order to get the annual, we just take that, multiply that by 2, then we get, should be what?
7.
So if you go back to the rate part, the formula,
Mm-hmm.
and if you put in 60 instead of 30,
Mm-hmm.
then you should get 7, right?
Should be the same, yeah, should be right. There will be a little difference because of the way it's compounded. Mhm.
So the annual yield will be 7%.
7.01, yep.
Yep, it comes exactly same.
Okay, and
What else?
what else? Number five. Number 5 is the yeah. Multiple choice.
So if a stock is trading at 30, call options are available. We have a call option, we want the stock to do what? Go higher, right? So with a strike price of 25, that call is going to be worth what? Stock is at 30, call strikes 25, that call's going to be worth $5, right?
Right.
And what about the $35 one?
0.
Worthless, right? So which one fits the best? Let's see, the options with the 25 strike will sell for $5. Is that correct?
Oh,
Yes.
B is correct.
What about B? 25 strike price will sell for less? No, it's going to sell for more, right? The lower the strike price, the higher the intrinsic value. The options with 25 strike price have greater exercise value than $5. The option with 35 strike price have exercise greater value than 0.
No. E.
If the Eagle stock price rose by $5, the exercise value of the options with 20 would also increase by $5. That's true too. Actually, for this problem, I would have, the way they word, I'd have to take A or E as being correct. Because A states that that's correct, right? 25 strike price, 30 price, $5 option worth, that's true. E, if stock price rose by $5, that strike price, that option's going to rise by $5 too. Okay.
3.
That's right.
Yeah.
Uh-oh. It's words.
Oh, I
It's
selected
words.
D, C. Okay, that's a
If
no.
debt financing is used, percentage change in net operating income will be greater. Your percentage change in net income. Is that correct?
Percentage change in net operating income will be greater than given percentage change in net. No, really.
because net operating income doesn't then take into account what?
Interest.
The interest payments, right? Net income does, right?
Yes.
Mhm. The percentage change in net operating will be equal to a given change in net income? No. The percentage change in net income relative to percentage change will depend on the interest rate charged on debt. Once again, net operating income, it doesn't apply, right? It only apply to net income because net operating income doesn't subtract out interest. Percentage change in net income will be greater than the percentage change in net operating income. Or percentage change with sales will be greater than the percentage in EBIT. EBIT is before what? Interest payments also, right? So interest, financial leverage means I'm taking on debt. I'm taking on interest payments. That has no effect on net operating income. That only has effect on what? Net income. Because net operating income is here. Net operating income is the same as EBIT.
Yeah, right.
Mhm. So how much leverage you have doesn't have any effect on EBIT. It does have an effect on your net income. Mhm. Huh? Those words. Yeah. Yes, no? If you have any problems, you can ask Matt, he can come and correct some. Just trying to jinx you for the quiz.
Yeah.
All right, let's start. Number 30. Ooh, risk management. Risk management has become quite a big deal. Why? Because if you leave it to crazy people like me, because I want to make money, I take on a lot of risk, okay? So every bank, every insurance company, anything that invests money will have a risk manager. And what will they do? They will watch what you're doing, what you're investing in, versus what everybody else in the company is doing, investing in, and kind of set a risk profile for the company, okay? Net everything all together because one person could be buy a bunch of stocks and this other person could have sold a bunch, so that kind of nets to zero, right? They have to look at it from a whole firm perspective. Risk and risk managers are considered a committee of no. Mhm. That's what I call my life at home, committee of no. Can I? No. What about no? Mhm. Property insurance. Does property insurance reduce risk? If you're in Houston, do you hope you have flood insurance right now? Yes, Houston's
Texas.
underwater, exactly. Mhm. So you better look at the insurance policy right now and go, okay, what's going on? And then the insurance company's going, how do we get out of paying this, right? He's on the other side. How do I offset that risk if I'm the insurance company, though?
By ensuring a wider group of people over a larger area.
Geographic area, right? If I'm concentrated in the Texas area right now, I'm in trouble, right? Hopefully, we have insurance all over the country, therefore we're going to have some, what? Diversification, right? So we won't take that big of a hit. And then what happens is the best time to write insurance is when? After a flood, after a hurricane. You know why? Because everybody thinks, oh, it's going to happen again next year. Remember when New Orleans Katrina happened, everybody said, oh, it's going to happen once every 5 years? Well, guess what? It's been 9 years? 10 years? So the insurance companies can raise their rates. People will pay for it because they still got that fresh in their mind. Business liability insurance. Some aspect causes harm to a third party. probably the best example would be a place that serves alcohol. And they go to, that person goes out and hits somebody driving, right? They're gonna try to come back and sue that business. Why? That person probably doesn't have money. The lawyer's gonna look for somebody that does have money. Who has money? The bar, hopefully. Is there insurance against that? Yeah. If you're a bar or a place like that, it's cost you quite a bit of money. Right? But then this liability insurance on top of it. I mean, and you gotta be careful too about watching who you serve and watching who comes through your doors and, you know. Business liability is also kind of in the medical field too, medical malpractice, right? They mess up, they usually mess up pretty good. Right? I think in the, what did my wife's doctors say? Oh, the OB/GYN. I think he paid like $300,000 in medical a year. Impressive. Business interruption insurance, just of the business. Something happened that hurt my business. Okay? Fire, accident, or some other insured peril, right? Guess what happens? Your restaurant's not doing well. What happens? It caught on fire. Did that happen in Chicago?
No.
Yes, it's
Something was lit on fire.
They call it a grease fire, but they use the GREECE. Because I believe people own family restaurants and they catch on fire. Or there was electrical work that was being done at the time. So the insurance company has to go in and have their examiners look at that. Was this a legitimate fire? Well, this is what happened. Okay. Should you have that kind of insurance? Yeah, you should. Key personnel. Top 4 or 5 people of usually every company are insured. Sounds kind of weird, but some are worth more than others, right? Is Warren Buffett worth more than probably a lot of people? As far as for his business? I am sure that his board of directors' job is to insure key personnel. I'm sure he has quite a bit of key personnel insurance on him. If he dies, they'll get quite a bit of money, but that will not offset his ability, right? Okay, a refinery has a 0.2% chance of being destroyed by fire. If it is destroyed, the firm estimates lose $150 million in lost business. Okay, here we get into little percentages. So what's the likelihood of it's going to happen? .02%, right? So given the amount and the value, what can we do? Take the 150 million, and we'll do what with it? Multiply it by the chance of it happening, which was what? Now that's 0.02%, right? So that's 0.0002, right? The probability that's going to happen. $30,000. Okay. Now what does that $30,000 mean? Given the chance of it happening, the expected loss would be $30,000 in each year, if it does happen. Okay? So how much are we willing to pay? If we're going to lose 30 per year, how much are we willing to pay?
30,000.
We want to offset the risk. When we're looking at risk, we don't want to make money. We want to offset our risk, which in this case would be 30,000. Who come up with a 0.2? Probably some statistical person. Could be the insurance adjuster too. They have statistics on all this kind of stuff.
Was that a contingency then?
Hmm?
It would be a contingency of
Contingency as far as,
Well, I got what's probable or,
I mean, it's a probability-based thing. Let's just say that's how much you would pay. If you have a higher probability, someone else who has an older refinery might have more risk. Probability could be higher. But the minimum you would consider paying, anything above $30,000 a year, you're not gonna pay. Okay? And, you know, probabilities could be that short too, but what they'll usually do is get a lot of people's opinions, crank them into one thing, and then decide what the mean or the median opinion is, and then use that. All you're trying to do is protect yourself against loss. You're not trying to make money, okay? Insurance premium, we all know what that is. That's what we have to pay, right? You know what actuaries are? What are actuaries?
Oh, I'm sorry.
That's okay.
Oh, well, they work for insurance companies and they come up with those numbers actually, don't they? They're the ones who come up with the risk
Your
numbers.
life insurance actuary, they tell you when you're gonna die. Given what you have and just the genetics, whatever, they can come up when you're gonna die. And they have to do that for what? Pretty much every one of their policyholders, right? Because all of a sudden, you gotta know, hey, if there's a lot of people that hold my policy that we think are gonna die in this year, then guess what? We're gonna need a lot of cash in that year. We better structure our investments, our bond holdings, so that we're gonna get a lot of money in that year to offset that, okay? But they can do it for anything. And there's actuarial tests, you can be advanced actuaries, you go up to levels, different levels, 3 or 4 different levels, I think.
So quick question,
Yes,
can the insurance company go bankrupt?
yes.
Then what happens to the people who bought the insurance from the insurance company?
See, that was interesting, because AIG went bankrupt, but AIG Insurance didn't go bankrupt, really. So the insurance part of the business was fine. It was what they were doing outside of the insurance business. Usually the states will pick it up. See, because insurance is not a national thing. Each state has its own regulations. So whatever state you insure in, you have to follow their regulations. So if you're in 45 states, you have to follow 45 different regulations. And they do supposedly pay for that too. Kind of like for FDIC insurance, they do pay for it. Well, that's what most people worry about with AIG, where they're worried about their insurance. And actually, the insurance side of the business was perfectly fine. It's what they're doing on the other side. Okay? Insurance premium, this is actuarially fair. Okay? Profit or loss times the expected payment in the event of loss, 1 plus the risk, RSDOF, risk of being insured. Okay. What do they do? We said they pool together, right? Would it be better for me to insure over one refinery or many refineries in different locations? Either a lot or none, not just one, right? Not all insured risk have a beta of 0. How do you diversify against a hurricane or an earthquake? Especially if your business is in just one location. If you have a medium-sized business and your headquarters is in Houston, Texas, maybe it's flooded, right?
Buy insurance from somebody else.
But
Delegate.
to diversify completely is kind of tough, right? Beta of 0 means what?
No risk.
No
Basically
risk.
no risk. You'll have to have some risk. What could be the risk? We said earlier, if I'm a policyholder in Houston right now, what am I looking at? What's my flood coverage? Because you know what they're going to put in the small little type down there, right? We covered it, except for
All natural causes.
except for basically what you need covered, we're going to cover, right? So even though I might think I'm insured, I might not be completely insured. Okay? Insurance is not a versatile hazard, they're a negative beta asset, pays off in bad times. When things go bad, that's when insurance happens. Do we want to use insurance? No.
Yes.
It depends.
Depends.
We don't want to use it. We have to have it though. Right? We don't want to get in a car accident. But if we do, guess what? We feel better if we're insured, right?
Peace of mind.
It's like medical insurance.
Yeah, same thing, exactly, right? Do you want to use your medical insurance? They rush you to the hospital? No. Mm-mm.
But if you go
Okay.
to the hospital,
Yes, then you need your insurance, right? Mm-hmm. So think of it as insurance premium, option premium, things like that. Premium is something we pay, right? Do we want to use it? Absolutely not. As a business, we don't want to use it. As an individual, we don't want to use it. Because if we're using it, what happens? Something bad happened, right?
Yeah.
We don't want to use it. Oh, $1 billion in the event the building is destroyed by terrorists. Okay. Likelihood, the risk of loss is 0.1%. Risk-free rate is 4%. Expected return is 10%. The beta is 0. What is the actually fair insurance premium? Hey, guess when I wanted to write this insurance? Right after 9/11. 2001, right? I'm an insurance company. Look what happened. I mean, you bet. Because guess what the insurance company said about that attack? Do you think that was covered? Policy is not covered. So. Sorry. Then you turn around and then you do what the next day? Hey, would you like to buy some? Okay, so the expected loss is $1 million, right? Take the 0.1% and multiply it with the value of the bill is $1 billion. Beta of 0. We take the 1 million divided by 1.04. 4% was my risk-free rate. That's 961, 538. Using the CAPM, we plug it in with a beta of negative 2.5. What does that give my risk of loss at? A negative 11%. 1 million divided by 1 minus to negative 11%, 1.1245. Exceeds expected loss. Negative beta of risk. So, if the premium exceeds the expected loss, is that a good thing or a bad thing?
it exceeds it.
So how can it exceed to the expected loss?
So I figure the premium's going to be what? $961, right? $961,000. What did I calculate my risk of loss being?
1 million.
Mhm.
So it is not exceeding, right?
So is it a fair thing? Is it fair? It is fair. The bottom line number, the one we figured out, the bottom, 1.124, that's what I'd be willing to pay. What am I going to pay? 961. I'm willing to pay up to $1.124 billion. After that, guess what? It's not worth paying. Okay? Take the expected loss, divide it by 1 plus the risk-free rate. Why do we do that? That $1 million is paid when? Maybe 1 year from now. We could invest in 961,538 at a rate of 4% to get $1 million a year from now, right? Then we calculated the risk of loss, R sub L, by using the CAPM. 4% risk-free rate minus 2.5 beta. 10% expected market return. 4% minus 11% was the risk of loss. Take the 1 million divided by 1 minus the risk of loss. Okay. So my insurance premium, as long as it's less than my actually fair premium calculation, I'm okay. Okay. Concession goes to the major airport. You decide to purchase insurance that'll pay $2 million, the airport is destroyed by terrorists. Boy, we're having a positive day today, aren't we? Suppose the likelihood of such a loss, hey, I didn't touch what I did. Did I touch it?
You broke it.
Oh, I didn't.
You got insurance?
Oh, I got the guys downstairs. Here. So, $2 million times what? Okay. So, I've got $2 million times, dollars, times what?
So one.
0.05%, right? So 0.00. Well, what's that number going to give me? When I multiply the 2 million times that. Okay. Now, what do I need to do to figure out my premium? I need to take that 1,000 and divide it by what? 1 plus the risk-free rate. So, I have 1,000. I'll do this underneath. 1 plus the risk-free rate, right? Then I'm going to divide it, right? That's my premium. Okay? Now, how do I determine my other one? What do I need to know? Well, what does it tell me? To use this capital asset pricing model, I need a expected rate of return on the market, right? I need a risk-free rate, and I need a beta, right? So, for the CAPM, my risk-free rate is 3%, right? What's my beta? -3. And then I've got my market risk premium, which was 8%, right? Minus the risk-free rate. Okay. Take the beta. -3 times this, right? That's right. Bring down to 0.03. And add that. What's that going to give me? So that's my R. So what? So Bell, right? So I take $1,000 now, right? From above here. This calculation.
Divided by
1.
1 plus,
I'd like to do 1 plus what?
it's gonna be 1 minus 0.
Minus 0.11.
1, 2.
Oops, sorry, 1, 2, that's right. Is that okay? I'd be willing to pay up to what? $1,136.36. Premium, I'm still thinking is $978.70, right? Am I okay? Yeah, I'm okay. First, we figure out what our expected loss is. Take the dollar amount times the probability of it happening, divide that by 1 plus the risk-free rate. Okay? Premium.
Where do you get to the probability of happening?
That'll be given in the problem.
So you want to do like a real life problem?
The real life problem,
To say my car,
your car, probability of wrecking it.
or being stolen or whatever, how is there like
The insurance company would know that based upon your past history.
Also-
Do we have had accidents?
Once.
Well, wasn't your fault, though, was it?
No.
Okay. Well, what happens if you have more accidents? What happens? Premium goes up, right? So, in actuality, is it going to be really hard for you to do this as an individual or a company without having a? You ever hear of There's companies that broker insurance. They will help you with this. They will tell you what's a good premium, what's a bad premium based upon their assumption, based upon what they use. So that's why people, large companies, pay for a brokerage that does insurance. Therefore, what they do is they go to all these different insurance companies. They'll take your assumptions, look at them, and decide what's the best rate for you. How will they do it? Using some manner of this. For you as an individual company, it's not going to be that accurate because you don't know what they're looking. You don't know exactly what they're basing their decisions on, and they won't tell you either. Because what do they want you to pay? More, right? Do they want to give you a deal? Heck no. Okay, what can value insurance? Bankruptcy and financial distress. How could we insure against our own financial distress? Right here. Maybe a little fast, but I don't know if you've heard of these things before. You ever hear of those? Credit default swaps? What they will do is, this is insurance against a bond of a company defaulting. I pay a premium, I own the bond, and I'm worried about the company. Well, if it's a highly rated company, this insurance is going to cost me very little. If it's a low rated company, it's going to cost me a lot more. This would protect me against that. Could a company do that against their own bonds? It could. Would it save them a bankruptcy? What would happen if their bonds went to zero? Well, they would get the full maturity value back of those bonds. Huh? But you got to find a person to sell you. Who will sell you those? A lot of brokers. Who was the king in 2006 of selling credit default swaps? AIG. How did that turn out for them? Oh, Lehman Brothers would never go bankrupt. Sell credit default swaps. Sell, 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 sell. Now we got to pay out on them. Issuance costs. How hard is it to raise cash, or how expensive is it? A bond, not as expensive as a stock issuance. If your credit is bad, it's going to be hard to even issue a bond. Okay? So, suppose the risk of an airline accident, thank God I flew last week, is measured as 1% with a beta of 0. If the risk-free rate is 4%, so we have $150 million, right? Policy is going to pay me at a 4% risk-free rate. 150 times what? 1%, right? Divided by 1 plus the risk-free rate, which is
4%.
4%. Now, the question is, what is the net present value of purchasing insurance for an airline that would experience $40 million in financial distress costs and $10 million in issuance costs in the event of the loss of its insured? Okay. So, first was that was an airline accident. Now it's saying, what would happen if I would have 40 million in distress and 20 million. Huh. So how do we figure this out?
It's 10 million, not 20 million.
If it were what?
If it was uninsured, then it is 10 million.
Mm-hmm. What other information do we have? The risk-free rate of what? 4%, right?
Theta is 0.
It is 0.
And total payout is 150.
And that's actually for a premium that's gonna, the policy will pay 150, right? So we said we take the 150, 150 million, right? Multiply by
1%.
percent, whatever that equals, and then divide that by
1 plus.
risk-free rate, right?
Mhm.
What about the uninsured part of this?
It's covered as a policy.
That's what we calculated there, right?
Yes.
So that's 1.44 million.
So this is the premium, 1.44.
Total benefit of insurance to the airline plus an additional 50 million in distress can avoid if it has issuance. Thus, the NPV from purchasing the insurance, why is this a negative?
Because it's a current value.
Because we take it out of our pockets to pay the.
That's what we're paying for the insurance, right? We're paying this. So my NPV equals this, right? What's the 1% coming from?
So this is the last year,
The occurrence.
the expected.
So we have 1 point, negative, we have the 1% here, right? Now what else do we do? We multiply that by what? The 150 plus the 50, right? Then we're going to divide that by 1.04. The net present value would equal what? 480,000, 0.48 million. We got how much the insurance would cost us, our premium, right? What did we add on here? We added on another 50 million, right? What was that 50 million? 40 in financial distress and 10 million issuance costs. Okay? What would be the event of a loss if we were insured? $40 million. If we try to issue a bond as an airline company after a major accident, how's that going to go for us?
Sorry.
We're going to try to issue a bond right after a big airline accident. Who's going to step up and buy?
Most of the airline, but the beta will be higher. And the percentage of occurrence will be higher.
Same thing for railroad accident, right?
Mhm.
Got the train in left Philadelphia, right?
Amtrak.
Only supposed to catch the curve at 50 miles an hour, 55, just going 106. Now they're going to put, they said they're going to put cameras in all the engineers' compartments to see what they're doing. And maybe they don't want to see what they're doing. Okay, so, real quick. Purchasing insurance from an airline that experienced 25 million in financial stress and 15 million, similar to what we just covered. Expected loss, divided by that, we know how to do that. The NPV, similar example, plus the issuance cost of $40 million, and distress and issuance cost, divided by the risk-free rate, and with the policy plus the 1.2, which was 1.2 per year accident chance happening. Tax rate fluctuations, debt capacity. The more debt we take on, what happens?
More expensive.
And also more
Risk.
financial risk for us, right? We make a lot of money, it's really good. Managerial incentives? Volatility. What can I control? What I can't control, I can insure. Right? If I'm on a cruise line, what's risk that I have?
Weather?
Weather,
Sink.
bad captains that run aground, right? That not only costs me damage to that boat, but what else?
People.
Yeah, what happens to people?
Yeah.
They'll sue.
But you're gonna go on, who's gonna go on a cruise then, for that, with that cruise line? Right? Also illnesses on the boat, have you heard of that? Remember some, what was that with blowing around, right? You don't want that on the boat. All different types of things that he could possibly insure against, right? If I see him insuring against this as a customer, I'm a little nervous, right? But it's good risk management. Transferring risk, moral hazard, method imperfections, deductible. Deductible is what we have to pay for the insurance kicks in, right? The bigger the deductible, the lower your premium is, right? Monthly limits, severe selection. Insurance be attractive. Benefit the firm must exceed the additional charge by the share. We know that. Commodity price risk. Airlines. What's their risk for commodities for airlines? Guess how many gallons it takes to fill up a 747?
10,000.
10,000.
10,000.
Oh, way more. 332,000 gallons. That'll get you about 12 or 13 hours. That'll take you to Tokyo. One way. Multiply that, take that times $4, right? That's a variable cost. Your flight staff, your pilots, fixed costs. What should you try to do? You should manage that risk. How can we do that? Well, what's our risk? Our risk as an airline is that oil prices go higher. So we will buy commodity oil contracts that make us money when oil goes higher. We lose money in our everyday business because oil is going higher, but hopefully that commodity contract in oil will save us some money. The problem is when do we hedge? Right? Some people hedged up at $190. Now oil is $58. But if you don't hedge, you wind up like Northwest Airlines and you go bankrupt. Northwest was very proud of their not hedging. Vertical integration. Delta Airlines, you know what they did? They bought a refinery. Well, what the heck are they doing? Why are they building a refinery? They're an airline. What would you want a refinery for?
Price is going up, you make money there, but lose it in your airline business.
Also, being in the refinery business also gives you knowledge of what's going on out there, right? Because you're seeing the job of refineries to do what? Buy crude oil, process it, and then sell it, right? Gasoline, diesel, whatever. So what can you see? I can see how the supply is. The supply is very weak. Interesting. Prices might be going higher. I should hedge. A ton of people are wanting to deliver me oil. Guess what? A lot of supply out there. Maybe I shouldn't hedge from it because I think prices will go down. Gives them another view. They actually did it, but most people thought they were crazy. And that would be like a vertical hedge. Okay. That's an inventory strategy. Instead of you getting it from a distributor, you buy from you buy the distributor. Okay. Long-term storage of inventory. Right? Some things we can store. Right? Can we store oil? Yeah, we got a big place somewhere. We store a bunch of it for the United States, right? Can we store corn?
No.
Can we store grain, right? Some of that stuff you can store. Is oil storage going to be more expensive than gold storage?
No.
Hard for gold to catch on fire, right? You have
Security.
a bunch of barrels.
Security.
Mm-hmm.
Gold will need a lot more security.
Security, but also the damages, right? Your inventory could walk away, it's gold. Your inventory could explode if it's oil, right? And you can't just store it anymore either because of all the regulations that they have nowadays, right? I can't go, hey honey, we're gonna buy $1,000 a barrel, or 1,000 barrels and sit on it for a while. Where are you gonna put it? In the backyard. Next to the barbecue, see what happens. Mm-hmm. That doesn't happen. Mm-hmm. Southwest Airlines. Why are they successful? Because they hedge. Mm-hmm. They were hedging oil when it was $20 a barrel back in 2000. Mm-hmm. All you're not trying, the money you're making on your hedge should be offset by money you're losing in your business. Is it going to be a perfect one-to-one relationship? No, it's not. What you're trying to do is you're trying to make your loss from your business smaller than if you were hedging. Mm-hmm. Well, who cares about the price of corn? Hmm?
Everybody cares. Most of the processed foods comes from corn.
If I'm a farmer, what am I worried about the price doing? Going down. If I'm a consumer, I'm worried about the price going up. If I'm a producer, I'm worried about the price going down, right? I said as a consumer, I would buy oil contracts, being an airline, because I would lose. As a farmer, I would sell corn contracts. In case corn does go down, I make money and it offsets my business. Okay? All the frozen food producers that buy corn, they probably have a hedge like that. They're worried about that too. What are they worried about though? High prices, right? It's harder for them to pass on prices. Mm-hmm. Long-term contracts, cocoa, Starbucks. They hedge coffee? Mm-hmm. Absolutely do. Mm-hmm. Even though they charge how much for coffee? You got the fancy stuff in there, foam, no foam, I don't know, fat, non-fat, low fat, grounded, venti, whatever it is. Right? Do they hedge? What's their major variable? Price of coffee. Price of coffee goes down, what happens? They make more money. Price of coffee goes up, money. Mm-hmm. Could be crop damage, yeah. Crop damage hurts everything, right? Remember the drought, was it 3 years ago we had? Corn. Well, a few times in my life I was trading in corn, but the drought was there, and guess what happened to demand? Stayed the same. Supply went way down because of the drought. Mm-hmm. So wherever there's a risk, we could use a commodity hedge if we're in that type of business. We could hedge with futures contracts, which are traded at the Chicago Mercantile Exchange. So if the old days of a farmer, and he might still wear the overalls, but guess what? He's got an office with several computers in there. What are those computers doing? They're focused on the price of whatever he's growing. Because he wants to know what's going on in the marketplace. He knows what's going around him and the farmers that he knows in his area, but he doesn't know what's going on outside of him. What's one way to look at it? Look at the futures contract price. Prices are going up. My crops are okay. It's a good sign for me, isn't it, right? Prices are going down. It's a bad sign for me. What's going on? Too much supply. Huh? The next 2 years, what happened with corn?